Yeah, good afternoon, everyone, and thank you for joining in today on what we believe is a very exciting webinar. And I've got with me Harshad to join me. Harshad Boravke is head of research and been associated with the firm for now 8 years, manages our hybrid funds, aggressive hybrid, along with BAF, balanced advantage, multi asset, etc. And what we'll try and do is over the next 30-40 minutes, decipher from him the view on markets, how we should be investing, and also decipher how the overall outlook remains for investing. So, Arshad, coming to the last couple of years, it's been a roller coaster ride, honestly. You've seen that 2022-23 were great years for equity investing. Suddenly, from maybe last year, September 2024, equity markets has suddenly not been able to deliver returns. And during this period, gold and silver has done phenomenally well. Over the last 2-3 years, seen that the RBI cut rates aggressively and interest rates moved down, which means debt funds also delivered good returns. In spite of rate cuts on a pause, interest rates have started to move up in India. Now, in this sort of very confusing environment, I'm sure investors must be thinking where to invest. And logically, what we've seen, Arshad, is usually investors chase what has done well in the previous year or so. And hence, if you see the last 3 months, 6 months data, it will tell you maximum flows are now moving towards maybe commodities or gold and silver and not that much to equities. And we keep saying that Morningstar does this research very frequently, where it tries to show investors' return and tries to map it with the investment return. And we always see a huge gap between what the investors have been able to generate, but what the fund has been able to generate. And that's got to do with behavior. And what we will want you to decipher is how you can train our human emotions to invest using hybrid funds. So let me start by asking the first question is, in this sort of market scenario where always you will see whether it's equities, fixed income, commodities having various cycles, what you believe becomes a USP for hybrid funds and how investors can use hybrid funds for creating a good investment experience.
Sure. Essentially, you're trying to ask or understand, the importance of hybrid funds
Correct.
in the context of, what is happening in the last 2, 3 years, more so in the last, say,
Yeah, and I would say why you believe hybrids are a very good structural ways to invest into it
sure, sure.
as important parts of an investment behavior.
Okay. So let's try to see, while many of the viewers would have already known, but just to recap, what are hybrid funds, right? So hybrid funds, essentially, as the name suggests, is a combination of different asset classes.
Correct.
For today's conversion, which is balance advantage fund. So the three asset classes which are part of the balance advantage hybrid fund. One is equity, second is derivatives, and third is debt. So
Sure.
these are the three different asset classes. So first, I think important point which hybrid fund does for an investor is it offers diversification.
Okay.
Why diversification is important? So as you started initially, so one really doesn't know which asset class will do well in the coming period or the period in which investor is invested into that asset class.
Sure.
So to that extent, it makes a lot of sense to diversify across asset classes. Like people say, don't put all your eggs in one basket. It's similar
Definitely.
to that. So hybrid funds helps you diversify.
Sure.
That's point number one. I think second important factor, typically what we see the kind of investors who come to the hybrid fund could be the first time investors, people moving away from, let's say, fixed income.
Sure.
So there, I think what is important is that, the volatility should be smoothened out.
Sure.
So what the debt portion of the hybrid funds take care of, the lower drawdowns. So whenever markets are volatile, so the experience is much, much better in the hybrid funds from the smooth returns perspective.
Sure.
I think the third important factor for, any investor, according to me, is that a good fund is a fund which helps you stay invested for long term, right?
Sure.
A good fund is not necessarily, which will give the highest return.
Correct.
The good
Correct.
fund is the fund which you will
All
help
weather
you,
product.
which will help you achieve your goals.
Okay.
So, I think investability is much higher in the hybrid funds. So if
Okay.
you go back recent example, right, during the COVID, so
Hmm.
if you look at March 2020 data,
Right.
so investors, given the emotions which play a very important role, which you
Absolutely.
alluded to. So emotions in the volatility, kind of you greed, fear, those kind of emotions come into play. So in March 2020, what we saw the data suggests is that there are a lot of redemptions on the pure equity funds, but that was not the case in the hybrid fund.
Okay.
So there, people remained invested. I think these are the few things which makes hybrid funds kind of very important from the asset allocation or from the investors allocation point of view.
Sure. So Arshad, like you mentioned, there are various types of hybrid funds. So you got, say, on one side the aggressive hybrid funds, you got equity savings on the other side, and you got in between, say, maybe the balanced advantage and the multi-asset products. Now, considering that hybrid funds provides flexibility to be aggressive on one side, going maybe conservative on the other side,
Yes.
and also lets you be flexible. I wanted to understand from you, where do you think balanced advantage funds remain in this entire circle? Can they be aggressive? Can they be conservative? And what helps them to be able to capture both the aggression as well as caution whenever the market conditions were to change?
Sure. Good question. I think this will help us recap, what are the various products within the hybrid category.
Sure.
So yeah, as you said, at one end, you have equity savings fund. Typically, equity portion is between, let's say, 20 to 45%, depending on, various
Correct.
strategies. At other extreme end, we have aggressive hybrid, where equity percentage is between 65 to 80%. So
Correct.
positioning of these two funds is largely pretty clear. Very conservative, go to equity savings.
Correct.
Relatively aggressive, go to aggressive hybrid.
Correct.
In between these two, you have two dynamically managed funds. When I say dynamics, I'll come to the dynamism, how it works.
Sure.
So one is balance advantage fund and second is the multi-asset allocation.
Sure.
The difference between balance advantage and multi-asset allocation is that you have an additional component of commodity in the multi-asset.
Okay.
And which is not the case in balance advantage. Now, how dynamic, when I say dynamic fund, so what does that mean? So here, the equity portion can be between, for our fund, can be as low as 30%.
Okay.
And on the higher end, it can go 80%. So
Sure.
30 to 80, this is the range, we are talking.
So equity savings to aggressive hybrid.
Equity savings to aggressive, perfect.
Yeah.
So this is the dynamism which we have. So what is important here is for you as an investor or anyone, so you don't have to worry where the market levels are, where the markets will do well or not, what is my tax incidence, which is very most important in the Indian context.
Correct.
I think all these three worry parts, and whether it's right time to invest or not, should I go to equity, should I go to debt, there are so many questions and there are so many answers, right?
Correct.
So I think in this context, balance advantage fund is a kind of a sweet spot or answer to all the questions, I would say. So when the markets become, let's say, so-called overvalued, then we reduce the equity. When markets become attractive, we increase the equity. So
Sure.
if you look at our own fund, right? So we started, I think, at the lowest level, we were at some around 40%. At the higher level, we went at 58%. So that's the range, which we have moved in the balance advantage fund.
So what you're saying, essentially, balanced advantage and multi-asset give you flavor of doing aggressively or caution depending on market condition.
Yes.
The only difference is multi-asset has to have the third asset class, which is commodities, and all three have to be minimum 10%. While the balanced advantage gets you be flexible without the need of the third asset
Just
class.
to add, if you were to do asset allocation at your end, so for example, if you buy some debt and try to sell in less than 1 year, there is a tax incidence,
Huge
right?
tax incident.
Which is not the case in mutual fund setup, where we don't have the tax incidence. I think it is a big advantage. I think.
Yeah, so a lot of people miss out on this small point that when you try and rebalance your portfolio, and of course you should rebalance your portfolio every 3 years based on the change in your risk profile, based on how markets are. If equity has done considerably well, then it makes sense to sort of book some profit, increase fixed income. Well, this can be done dynamically without tax incidents. So that remains a big sort of advantage for investors. Now, Arshad, we started the conversation saying markets has seen a roller coaster ride. right? So maybe 22, 23 were great years for equity. 24, 25 have been sort of soft years for equity, and markets have not done much during this phase. Also, fixed income has gone through its interest rate cycles of cuts, pause, etc. In this scenario, and with the news flow changing every day, with commentary from various elements,
Yeah.
where do you think is the various market segments looking like? So, how do you look at the equity market, fixed income market, and maybe commodities market from a 1 to 3 year perspective?
Sure. So yeah, equity markets, see, in the short term, as they say, markets can be volatile. But in the long term, I believe that markets are slave to the earnings.
Absolutely.
So last 1 year, when you were to say that markets were sideways or in a negative zone, I think the primary reason for that was earnings growth not coming through. So if you
Sure.
look at last 5 quarters, including the first quarter FY26 which went by, so for last 5 quarters we had this single-digit PAT growth for Nifty 50 companies.
Sure.
One of the key reason for the lower earnings was the consumption growth not coming through. Various reasons like inflation and
Correct.
different reasons for that. In the last 6 months, or let's say since the budget of this year, government and RBI has tried to do lot many things, right? We started with tax benefit, no tax below 12 lakh
12 lakh
rupees.
rupees.
Then we had this GST
GST.
rejig which happened. RBI did lot of things to infuse the liquidity, into
Correct.
the market. Then the monsoons are pretty good.
Yeah.
So I think the big issue for the markets or earnings, which was consumption not coming through. I think a lot of things have been done on that part.
Sure.
Now, if you look at second half of this financial year, second half in India typically is good from the corporate
wedding
earnings
season.
point of view because of
Yeah.
because of a lot of festivals,
Correct.
which are there. And again, there's a difference between rural and urban, right?
Sure.
So I think rural has been doing quite well for the last 1.5, 2 years. Now I expect urban should start to pick up. Early data, if you look from post GST rejig, early data is quite positive. But I will hold my horses. I will just see, whether it continues to happen till the next 1 to 2 quarters.
Sure.
But the long story short is, single digit earnings growth. Now we are moving towards double digit earnings growth. If you look at Bloomberg earnings consensus, while FY26 is at 7% earnings growth, but FY27, the Bloomberg consensus is showing 17% earnings growth.
Okay.
So to that extent, there is a lot of hope which is built in, and hope is just not in theory. There are a lot of things which government has done. Next year, one point which we missed is the 8th pay commission, which government will also implement. So to that extent, there are a lot of factors which will drive the earnings growth. So that's point number one. Secondly, if you look at what was absent in the last 3, 4 years was the private capex. So there, I think, if you look at the corporate balance sheet, one of its best right now in the last 10 years, be it banks or be it any other private companies. So what I believe is the RBI data is showing that utilization for the industry is at around 77, 78%. So I think that over the next 12 to 18 months, we should see, private capex coming back. So consumption will come back. Private capex, we are hoping in the next 12 to 18 months come back. And I think third important factor which is giving jitters to the investors is this global news flow, right?
Correct.
Either geopolitics or on the tariff front.
Correct.
So there, I think one can safely, while not safely, but one can say that the lot of big negative news flow is behind us.
Yeah.
Now it's more about negotiations. So in that context, I think the globally over the next 12 months should be supportive more than it will more tailwinds than headwinds.
Correct.
So net, long story short, on the equity front, I think there is a hope of earnings growth coming back. On the valuation front, well, obviously on 26 markets are not cheap, but on FY27, when I said 17% earnings growth, so on FY27, Nifty is trading at roughly 19.5 times FY27. If you look at last 10-year average, it's around 20.5.
Okay.
So
Slightly
discount on a FY27 basis. So equity outlook, I think, yes, time correction has happened. Now we are waiting for the earnings growth to come back. Once the earning growth is visible in the numbers, I think markets, equity market should be okay. On the debt side, I think obviously people are taking indications on the rate cut cycle. RBI has already delivered 100 basis point rate cut. If you look at our own portfolio, we have cut duration slightly now, I think somewhere around 3 years or so. But I think outlook remains quite good on the debt front, primarily because data is very supportive. So if
Okay.
you look at inflation numbers, growth numbers, to that extent, it is supportive. So maybe over the next 6 months, we should see one more, action from the RBI. On the commodity, I think, see, when we say
This is, I'm
commodity,
sure, a lot of people are interested to
yeah,
know.
yeah. So I think when you say commodity, so for us it's more gold and silver, right?
Correct, correct.
From the multi-asset or funds point of view. So I think last 3 years have been very kind to this asset class. While despite being gold, despite being the asset which doesn't yield or give any
Yeah, returns.
earnings,
Correct.
but it's more of a store value. So when we say store value, which means that the pricing power over the years is intact,
Correct.
largely in line with inflation.
That is maybe a risk trade which is going on. Is that could be a reason for?
See, I think two factors which I can think of. One is, if you look at what is happening on the global geopolitics front, right?
Correct.
So typically, gold as a asset class does well when there is a lot of uncertainty
Correct.
in the markets, which obviously is the case in the last 2 years. You
Hmm.
have a lot of events which is supporting that. I think the second important factor is, what is happening on the US as a currency, I'm saying. So US as a currency, is a reserve currency for
Correct.
lot many central banks. So there, I think because of this, various issues, uncertainties, what is happening is that people have started to buy gold as a reserve.
Correct.
So if you look at the reserves, so number one used to be US dollar, number two used to be euro, and number three used to be gold. Now gold has become number two in the last
Okay.
6 months. I
Big
think
change. Yeah.
this is a big change. I'm not really of the opinion that consumption is driving this the gold
Correct.
prices, because if you talk to various jeweler companies, at least in India, so they say that people are down trading from 14 carat to 8 carat now.
Ah,
So to that extent, affordability is a question
it's a
mark.
big question. Absolutely.
Affordability is a question mark. It's more driven by the global central banks.
Correct.
But I think let's be prudent. Mean reversion happens everywhere. So to that extent, after a 3 year, a big jump, one has to be cautious. Obviously, don't expect similar returns what has happened in the last. I'm not saying something negative, but I'm saying don't expect what happened in the last
Sure.
3 years.
So don't chase past performance. And mutual funds always have this disclaimer that past returns are no indication of future. But maybe I can summarize what you mentioned, that equity has gone through its time and price correction. Outlook remains constructive, and valuations still are reasonable compared to historical averages. Fixed income, again, outlook is positive. We are still in a rate cycle where interest rates could move down. And commodities, you should maybe manage it from a more asset allocation
Yes.
perspective rather than going significantly overweight. If you pull down all these three factors and these three asset classes, how do you marry this with your investment strategy in, say, balanced advantage fund, where you could have flexibility of, say, fixed income and equities, and you could move, like you said, between 30 to 80 basis your current assessment of equity and fixed income market? Where would you allocate between equity and fixed income, and what is the role of derivatives or arbitrage?
Sure. Sure. I think this is a good time to introduce how we go about allocating the equity in our balance advantage fund.
Sure.
So one of the important factor in equity investing is about managing the emotions. So you can take your own example in COVID. How many people dared to put in more money long back in
Absolutely.
global financial crisis. So those are the times where emotions get tested. Those are the time when asset allocations get tested.
Sure.
See, even you or me, we both as investors, while we are fund managers, plus we are also,
Correct.
people with emotions. So there, what we are trying to do here is that move away this equity allocation from the emotion part.
Okay.
So how do you do that, right? So the answer is simple. You go with data, you go objectively. So we have built a model.
Hmm.
So the model is based on the last 14, 15 years daily data points.
Okay.
What the model does, and I think we kept it very simple. We have kept it based on price to earnings and price to book. While price to book has a higher percentage while deciding the equity, and price to earnings is both trailing as well as forward.
Okay.
So very transparent data points. Anyone can build this.
Sure.
So based on that, we have built a model, and then the model kind of tells you the number of, how the current market valuations are vis-a-vis in the last 14-15 years
Okay.
average. So
Okay.
it tells you where the current market in terms of valuation, whether it is overvalued, undervalued, if it is overvalued by how much percentage, undervalued by how much percentage.
Sure.
And then at different points,
Hmm.
there is a equity allocation which is decided by the model. So
And you
we
also
did-
look at forward.
we also look at forward earnings.
Okay.
So see, we call it, as a roots and fruits kind of strategy.
Okay.
So, what I mean by that is that roots is basically price to book.
Okay.
So as you can understand, book value of a company doesn't really move too much on a year-to-year basis. So
Correct.
for example, in COVID, right, when companies lost the earnings for 1 year,
Correct.
so that doesn't mean the value of a company goes down by 50-60%.
Correct.
We wanted to stabilize the model, but for
Sure.
the earnings, earnings can be zero for a year.
Correct.
So if you were to build a model only on earnings, then it will
Become very
give a
volatile.
very haywire kind of results. That is the reason almost 75% weights we have given to price to book,
Okay.
25% to price to earnings,
Hmm.
and then the model decides where the asset allocation should be. There
Sure.
are different intervals at which we decide at this interval this should be the equity percentage, at
Sure.
this should be. Net what happens is that as the market valuation moves up, my equity percentage goes down, and vice versa.
Correct.
So we basically, the whole idea of doing and building this model is, kind of move away from emotional factor.
Makes sense.
There is only one caveat which I want to put is that we have some 3 to 5%, I would say, flexibility with us.
Okay.
Why that flexibility? Events like, let's say, budget, or
Sure.
let's say some big announcements on the global front. So on those kind of days, price to book and price to earnings don't capture those events immediately.
So you can take a preemptive.
We can take some preemptive changes
Action.
on those days.
Okay.
Yeah.
Fair. So basically what you do is the model throws out an effective number on, say, equities.
Yes.
And basis that, the remaining amount is then invested in arbitrage to ensure that you remain tax efficient.
So just on that, so taxation for us is equity taxation.
Okay.
So what that means is that at any point in time, we need to invest at least 65% in equity, which can be a combination of cash, equity, and arbitrage.
Sure.
So for example, if my model suggests right now, 55% equity. So the
Sure.
difference between 65 and 55, 10,
Hmm.
that goes into the arbitrage.
Okay.
And typically, if you look at arbitrage fund returns are largely in line with the money market fund returns that's we observed over
Sure.
the year.
So that arbitrage element gives you the tax efficiency.
Tax efficiency.
So, Arshad, Balanced Advantage has completed now 3 years of track record. And like you said, range has been in the 3-year period between almost 40 and 60%.
Yes.
So it's been quite a sharp change, I would say, in the 3-year period where you've got the flexibility of changing the allocation between these numbers. Based on how markets are today, how much would you say you allocate to pure equity and arbitrage? And within the equities, where would your investments be? Whether it will be more large, mid, small, how would the allocation will change?
Sure. So right now, if you look at last month data as per the models, model is suggesting 52.5% kind
Okay.
of equity. We are largely in line.
Okay.
So since inception, when I say while we have flexibility, but 95% of the time we have followed the model.
Sure.
Used flexibility in very rare occasions. So that's one. So 52.5 is equity, and the 65 minus 52.5 is the derivative.
Correct.
So that is what it is, and the rest is on the debt
Fixed
side,
income side.
Fixed income side. So returns, if you look at the returns of any hybrid fund are a combination of two factors, right? One is what is the asset allocation you have, how much you allocate to each asset class, and then what we buy within the each asset class.
Correct.
Right? So here on the equity front, what we have done by design, by choice, what we have said that given the investor profile, which comes to the hybrid funds, we have tried to keep it, and we have been keeping it large cap biased. So when I say biased, what we say that we'll at least be invested 65% in large cap.
65% of the equity.
Of the equity allocation.
Okay.
Right now, if you ask me, given the valuations are according to us, quite decent on the large cap side. So we are roughly at around 75-77% large cap,
Large cap tilt.
and the rest is
Mid
mid
and
cap
small.
and small cap.
But that is still run quite dynamically within what range? About 60 to 80% large cap and the remaining mid and small.
So while this is a young fund, but if you look at our other hybrid strategies,
Mm.
so there was a time where we went to 65% also on the large cap side,
Okay.
and the remaining
Remaining mid and
35 is
small.
mid and large. So the
Okay.
dynamism is not just between the assets, but within.
Mm.
It's like
Within
flexi
the-
cap fund, right?
Fair.
So whatever we find attractive, we invest in that. But
Fair.
coming to within that equity, how do we go about it? So it's a bottom-up approach in terms of stock selection. While obviously
Sure.
we do keep cognizance of the benchmark, largely to follow strategy, BMV, business management and valuation.
Correct.
All the three should be, a tick mark.
Sure.
And construct of portfolio is more barbell approach. When I say barbell approach, is like, let's say 80% of my portfolio will be the growth portfolio, and at the extreme end, it could be a value kind of a strategy.
Hmm.
So it works over the years. We have seen that it has beautifully worked. So it's not that we are adverse to value names. We buy value names. Obviously,
Correct.
whenever there's a trigger, which is available in the.
So there's no one particular bias in a style.
No.
You would be flexible.
Yes.
Fair. So, Arshad, now you covered equity and sort of how you allocate within equities. Coming to the fixed income part, and you mentioned that here you were dynamic in the way you reduced your duration. So maybe can you also cover how are you looking at the fixed income side as well, whether you will be in high credit quality or what will be your focus, whether it's quality, duration, how do you sort of manage this part of the portfolio as well?
Sure. So while the debt portion of this fund is managed by our debt team, but I think the mandate or way we have been doing it is very simple. Large part of it, or I would say almost 100% part of it, it's either in G6, which is the primary allocation, or the AAA, corporate bonds, high quality AAA corporate bonds.
So you don't take credit calls in this product?
We don't do that.
Okay, fair.
So that's one. Secondly, while it's a typically it can be a buy and hold strategy, accrual strategy, but we are as dynamic as any debt fund can be. So if you look at last, as I said initially, if you look at when the interest rate started to go down, so we reduced modified duration in the last 3-4 months. So from I think 3.7, 3.8, we are now down to around 3.
Okay.
So obviously depending on the interest rate outlook,
Sure.
we change duration.
And GSEC give you that flexibility
Yes.
of being able to change the duration quickly. So that could be one of the reasons of holding to government securities. Fair. So I do debt part is also sort of managed dynamically. So you got equity, within equity the allocation is dynamic, and fixed income sort of also being dynamic. So overall, as a fund, you would take dynamic calls across both. Would you take cash calls ever in the fund?
We don't do that. And say anyways, it's asset allocation kind of, I would say, strategy. Within that, we further don't want to do cash calls. We have never done that. Maybe unlike your pure equity funds where we have cash, let's say between 1 to 3%, here it can be 3% or in around 3 or 4, not beyond that.
So if you have cash, you will either use it in arbitrage or
Yes.
fixed income, but not take any cash calls. So Arshad, Balanced Advantage has now completed 3 years. It's been a good sort of 3 years journey for you. Compared to the benchmark and some of the peers, is done quite well. And performance on maybe 3-year basis is among the top quartile funds which are there in the market. Maybe can you share some of the success reasons why you felt that the fund did well, and that could have led to the fund remaining in the better performing funds, or maybe a secret recipe you believe that you have which makes you different from some of the Balanced Advantage funds, if you want to share that.
No, I think, see, the guardrails which we had decided, right?
Correct.
So largely sticking to guardrails,
Okay.
in terms of when I say, we largely follow model, we actually largely follow model. We
Okay.
don't say that, I understand more than the data. We say
Right.
that, data is supreme. So whatever data suggests, we will allocate that.
But you look at the model if it needs tweaking, but you will always follow the model.
Yeah, we'll always follow the model. And the best part about the model is, we update it on a daily basis. So
Okay.
it's not that I have to wait for the month end or a week Friday or
So
something.
how frequently is a rebalance?
So we update on a daily basis. But what typically happens, because the equity percentage change is based on some intervals, right?
Sure.
So not necessarily it will start changing immediately, but we do get an indication where the data point of the model is moving. So what we try to do, let's say in a 2-3 year period, if model suggests, to increase the equity, let's say by 2% or so. So then we do it over the 2-3 days period, and it's not necessarily additional 2% equities across the stocks.
Sure.
So there are 2-3 stocks where which we think are reasonably priced, attractively priced. Then that 2% equity goes to those 2-3 stocks.
Sure.
That's the way we run. But technically, it's a daily rebalancing, I would say. That's
Okay.
what it is. But
So it's sort of looked at very dynamically
it's
and
very
fair.
dynamic.
So that's maybe one sort of thing which makes it
Yeah,
different.
yeah. Coming to your answer question, I think it's more about one. You see, on the equity front, try to stick to the quality companies run by good quality management.
Sure.
In terms of valuation, our strategy is more buy up to a reasonable price. Growth, we want to buy growth, but not any price, up to a reasonable price. I think sticking to these basics have worked so far. And on the credit side, as I said, no credit calls. It's largely a G6 and triple. But we are very clear. Debt is more about stabilizing factor in this fund. It is not about making money out of debt. So that's what it is. I think the bigger part is more about asset allocation, and bigger part is also what we buy within the equity. Net I
Arshad,
think largely following wherever there is a earnings growth, you try to buy those companies. That's what it is.
maybe Arshad, like you said, one philosophy that you want to hold businesses for long.
Yes.
Now, assuming businesses go through some challenging period, and this is dynamically managed portfolio where allocation to equities can change within that range. How do you manage maybe some stocks which could go through maybe time or price correction? And how do you ensure that you hold to the businesses to still give you strong performance?
Sure. So at any stock, which comes or which we put in a portfolio. So idea is to hold at least for 3 years and beyond. That is what
Sure.
our time horizon is. If you look at our own portfolio, right? So 70 to 80% of my stocks would be similar what they were at the start of the 3 years back. So to
Okay.
that extent, 80% of my portfolio is more from the long term perspective. The last 20% is sometimes stocks move up, let's say 5%, stocks moved on 5% without any fundamental reason.
Sure.
So we try to tweak some weights.
Okay.
Sometimes there is some short term event in some stocks where we think we can take advantage of that, then we try
Sure.
to do that. But 80 90 70 to 80% of my stocks are from the long term perspective. And when we buy the stocks, when as I said, the valuation is paramount.
Sure.
So it really, for example, let me give an example of FMCG as a sector, right? So great sector, companies with 80, 100% ROC, ROE. But if you try to value them, so if you try to do a reverse DCF, right? It indicates that this company should grow at, let's say, 16, 18% till eternity.
Correct.
That's we don't believe that could happen. So to that extent, despite great companies with great ROEs, we are underweight. So to that extent, valuation is very important. Also, we try to take many a times sort of contra calls, right?
Sure.
So for example, 2 years back, when there was a lot of uncertainty on the pharma side.
Okay.
So we did believe, on the earnings growth, quality of companies, strength of different companies. So we took a contra call and we are significantly overweight on the pharma. I think that has worked very well for us.
Okay.
Let's say 3 years back, just giving few examples, 3 years back when sectors like PSUs, defense, railways were doing very well.
Correct.
Right. At that point in time, our thought process was, that from the valuation.
It would be difficult to ignore at that point.
Yeah, it was difficult to ignore. But we did, we were underweight at that point in time. But I think that has worked very well in the last 1.5 year. So one of the reason for Alpha is being underweight on this, because to start with many let's say private cap good companies, to start with they were at the valuation of 45, 50.
Correct.
At the peak, they went till 90, kind of PE.
Correct.
So we didn't understand at 50. There was no way we are going to understand at 90. We didn't
Correct.
chase the momentum or something like that.
Sure.
Generally, buy what we understand up to a reasonable price. That's our strategy.
Sure. Thanks, Harshad, for giving very candid answers. I'll tell you what we'll try and do is we'll take some questions from the audience.
Sure.
And we'll try and see what we can cover with all of them. So one question that one of the participant has asked, Mr. Amit, is what should be the advice on how an investor should be allocating in the current market? What should be the right asset allocation mix they should have in this market? I know not a very easy one to give, but
yeah, sure. So I think when I'm assuming he is talking across the fund types, including hybrid. So I think I would say that given the valuations, one can easily have 55-60% in large cap.
Okay.
And then the rest can be a combination of mid and small.
Okay.
But to start with, I think if somebody is first time investor moving away from FD, then I think let him start with the a hybrid fund.
Okay.
It could be a balance advantage or even equity savings fund. You start with that 70-80% because then you can put lump sum in these funds, right?
Correct.
Unlike other where I would advise to do SIP over the 3 to 6 month period. But here on the hybrid fund you can go lump sum. Maybe 70-80% you start on the hybrid fund. Remaining 20% either you start with large or large and mid. That's what one can do. But if somebody is a evolved investor, I don't know what is asking. But if somebody is evolved, if somebody wants to look at sectoral fund, I think this is a very good time to look at consumption fund. This is a very good time to even look at BFSI fund, given that we believe that earnings are kind of bottoming out, and over the next 12 months or so things could start to pick up.
Okay. So next question from Pinkal is that maybe can you highlight the overweight sector calls that you have within, say, across funds and maybe even balanced advantage? What are your overweight sector calls and maybe underweight calls?
Okay. Sure. So the big overweights for us are sectors like private financials.
Okay.
Then telecom, then consumption. But when I say consumption, within that it's more consumption discretionary, which are positive, which could also include things like building materials. For example, we had a big rally or big gain on the real estate side. I think now is the time for ancillaries to do well. The lead beneficiaries on the building material side, I think they should do well. Then of late, we also increased our exposure to cement. So these are, and then pharma, so these are the big overweight, themes for us. So basically, I think the common theme across this is, domestic focused companies.
Okay.
Given, what is happening on the global front.
Okay.
And underweight again on the same theme is, which are exposed globally, like oil and gas, where, we are underweight. IT, we are largely, I would say, mix of, underweight to slightly, equal weight, neutral. And on the auto side, we are constructive, but it's largely slightly overweight, but off late we are slightly, reduced some.
So we saw a good rally in auto stocks, especially after GST.
Yes.
So one question from Mr. Sunil is that considering the way market and gold and silver has done, do you believe this is a good time to be within the hybrid space in balanced advantage or multi-asset? Of course, both products can be part of investors' portfolio, but given a choice that you manage both balanced advantage and multi-asset product, what segment of investors can look at balanced advantage and what segment of customers can look at a multi-asset product?
See, I think the difference is very clear that multi-asset gives you commodity exposure. I think what I believe is that right now, given the run-up which has happened on the gold, silver is also slightly doing catch up because typically historically we look at silver to gold ratio. So one cannot make a definitive statement that the gold rally is over or those kind of things.
Correct.
So at a commodity particularly, it's very difficult to give a kind of say, because it is not driven by demand supply, right? It is driven by
Correct.
multiple factors.
Correct.
So in that extent, I think it's better to err on the safety.
Okay.
So in that context, I am saying ki you have allocation to both.
Hmm.
You take a call on gold. I think now is not the time, because the geopolitics issues are still going on, the tariff issues are still going on, the global growth is still slightly lower. So in that context, gold as asset class should sustain. That's what I believe.
Sure.
So I think net you have combination of both, but at some point in time you need to take a call and move away from multi-asset and go into balance advantage. Maybe
Okay.
this is not the time to give that clear call.
Okay. Fair. So there's a question from Mr. Raj Chaudhary. Is income plus arbitrage fund a kind of balanced advantage fund? So maybe I'll take this one, Harshad. So, Mr. Raj, income plus arbitrage fund is a fund of fund scheme which gives you exposure to investments across fixed income funds of maybe Mirae Asset or could be any other AMC as well, and helps you also invest in arbitrage. So it gives you a flavor of investing in our product across debt funds based on our view on fixed income markets, so whether we are positive on interest rates to move down significantly or we are sort of neutral in stance. So lets you move between debt funds and arbitrage funds within the same portfolio. To some extent, you could say it is like a balanced advantage fund, but the underlying is not equities. The underlying is debt and arbitrage, and you would try to change your outlook based on interest rates and spreads between fixed income and arbitrage. And the idea is to give you a very stable journey, while of course balanced advantage also creates in wealth, accumulation as one of the goals. And one advantage income plus arbitrage is providing to investors is the tax efficiency that you can get in this product. So it's a beautiful category, and maybe we will do a separate call on this one to explain this product in details. Question from Piyusha: based on all the parameters that you mentioned, how frequently do you check or rebalance equity and debt?
Yeah, so as I said, the model is updated on a daily basis. Not necessarily will change equity allocation on a daily basis, but over a 2-3 day period, we do change, depending on if something is attractive, we
Sure,
add those names or reduce those names.
fair. So question from Mr. Prakash: hybrid funds, should you do an STP to diversified fund? Is that okay?
Sorry, what is
From hybrid funds, is it okay to do STP into diversified funds?
No, I think the purpose is quite different, right, of both the. So in a diversified fund, you are very clear, whether you want to invest in large, mid, small, whatever.
Correct.
But hybrid fund kind of addresses your asset allocation issue. When you go
Right.
to a diversified fund, you are very clear, what fund you
Correct.
want, how much to act. So I think both are different categories. I don't need to
Anyway, just
elaborate.
to add to Arshad, basically the idea of STP is that you systematic transfer money from an asset class which is slightly stable to an asset class which is slightly volatile, so that you can take advantage of volatility which might happen. Now, hybrid funds, like Harshad already mentioned, if you were to see mutual fund industry, some of the hybrid funds over a 10-year period or a 20-year period have actually outperformed diversified funds. Well, diversified funds, because of the sheer right mix of getting equity and fixed income, and no market cycle goes through. Equity is always doing well. There will be cycles where fixed income will do well. So I would believe STP from hybrids to diversified funds will not make sense. STP into hybrid funds or diversified from fixed income funds definitely will make more sense, rather than doing from BAF to, say, a multi-cap product. Uh, there's a question from Jeet: are you planning to add REITs since now they have got equity taxation? And that's a good question, that taxation has become very favorable for REITs.
So when we got the permission, particularly for balance advantage, I don't think we were allowed to go into REITs. But now with this change, I think we will be allowed to, and if it is attractive, we'll definitely do that. So we have done in other hybrid funds. So whenever we thought the yields on the REITs are better vis-a-vis fixed income, at that point in time, we had
Sure.
added REITs. So
Sure.
here, yes, now if the permission is there, and if it is attractive, then we'll do add it. I mean, yeah, we're not
Correct.
averse to that.
So there's a question. Person's name is not mentioned. STG. I don't know. He's saying balanced advantage funds keep changing allocation between equity, debt, and arbitrage quite frequently,
Mhm.
which means I have to have complete faith in the fund manager's skill. What are the data points that you will look at, which can give comfort to that investor, that you are being able to make the switches at the right time?
Sure. So I think for us, thankfully, it really doesn't matter, at least from the asset allocation point of view,
Correct.
whether it's Harshad or Vaibhav or somebody else. So, there is a model which is in place. So
Sure.
even if I am not there, somebody else can look at the model, what is the value, and it can decide what the equity percentage should be. So there, I think it really doesn't matter who the
So it's a
fund
more
manager is.
process
It's more
oriented.
process driven and it's time tested. The
Correct.
simulation we have done. It's not that we just built one model and decided, and let's go with it. So
Hmm.
when you build this model, as I think at least 15 iterations, 15 different models were built, and
Correct.
out of that, one was selected.
Hmm.
So to that extent, I would say, while in practical you might be worried, but theoretically, I don't think there is reason to worry too much on whether the fund manager's ability to decide the equity
But maybe,
percentage.
Arshad, I can say if you're investing your money with a fund house or a fund manager, I'm sure you will have to have some faith in the fund manager and the fund house that they will be able to manage your money. But maybe to add to what Harshad said, this is more process oriented rather than being driven by tomorrow Harshad's view. That tomorrow he says, oh, I want to be 65% in equities, or day after he says, I can be 50%. That flexibility we have tried to reduce by creating a more process
Yeah.
oriented way, which the model helps define what should be the allocation. And of course, fund manager does have the flexibility to go overweight, underweight to some extent, but we don't want him to take disproportionate bets. See, in investing, I believe very important that we know that reducing risk is one of the best ways to improve return profile for investors. So we believe hybrid funds are a great way to reduce the overall risk on portfolios, and that's why they are able to give you much stable journeys. So hence, though your money is on the calls of fund manager and the stock selection, etc., but it's more process along with the fund manager's
Let
selection
let
element.
me also give you one nuance, of our model.
Sure.
See, Indian markets, what we have seen in the last 20-25 is, it's very difficult to call the top.
Correct.
One cannot be very certain, okay, this is the top, let me reduce equity.
Correct.
And we have seen that historically. So that's the reason, if you look at our own model, right? So when markets move up, we cut our equity slightly in a lower pace.
Hmm.
But at the same time, when the
Hmm.
markets start to fall, we add equity slightly aggressively.
Correct.
That is one nuance which we have built into our model.
Okay.
Yeah.
So that helps you enter at better times.
See, I
And
think we see at the end of the day, you are investing in the Indian economy,
hmm.
right? If I have to take a next 5-10 year view,
Hmm.
we can debate, whether the real GDP growth will be between 6, 7, 8. But
Correct.
the debate is not, whether it will be 0, -1, -2.
Correct.
So over the next 10 years, we are investing in an economy which is growing
The
at a
outlook is
higher
very
stage. Yeah?
positive.
Nominal GDP
Yeah.
growth is higher. So to that extent, the companies will start grow, markets will start growing. So eventually we'll make decent returns over the period. That is the reason I said it's very difficult to call the top.
Correct.
So we are a, let's say, 5 trillion economy, down the line $10 trillion economy. So this is the opportunity, which we
Sure.
are playing for.
Sure. Just let me see if there are any questions. So there's a question from Mr. Venkata. Please advise on multi-cap funds versus multi-asset funds.
So I think multi-cap is a pure equity, 100% equity fund. and multi-asset is a part of a hybrid category fund. So just to repeat, multi-asset will include equity, arbitrage, debt, and also commodity, which primarily is either gold or
Or silver.
silver. While on the multi-cap front, it's 100% equity, and then there are, I think, the market cap wise restrictions.
Yeah,
How much?
large, mid, and small each have to be minimum of 25.
25%.
So if you see multi-cap, it lets you invest across large, mid, small, minimum 25 each in all these three market segments. And multi-asset, like Harshad mentioned, gives you flexibility of being there in equities, fixed income, commodities, minimum 10%, and the up could be anything depending on the strategy. So very different in the underlyings that you invest, and the return profile as well. Uh, One question, Arshad, from Mr. Sudhir. He mentioned that in the last couple of months, he is an existing investor in our aggressive hybrid. He's seen that there's a dividend that is being announced. Is there a dividend policy you have for hybrid funds in general, or how do you look at that space?
Typically, I think historically what we have done, see, one is, dividend has to be paid out of the, profits which you make. That's
Correct.
typically what we have done, tried to keep the overall annual dividend between 6 to 8% kind of yield.
Sure.
While the frequency, as he rightly said, in the last 2 months, we have tried to move it on a monthly basis.
Okay.
But I think on an annual basis, 6 to 8% is the dividend yield we have tried to maintain. But as you know, depending on the fund performance, it may vary.
Sure. There's a question from Mr. Abdul Rahman. How about hybrid ETFs? Sir, very interesting one, and I'm sure we are all working towards launching hybrid ETFs as well. So you got actively managed funds where the allocation shift can happen. In case of passive indexes, you need the index to also move between these 3, 4 asset classes. So all of us are working together to create beautiful hybrid ETF solutions. And I'm sure in coming days you will hear from asset management companies on hybrid ETFs as well. Maybe last two questions, Arshad,
Sure.
before we close. There's a question from Mr. Abhaya. With a view to create corpus for retirement, maybe at the age of 60, and make SWP, what strategy should be deployed by someone maybe who has got 5 years from retirement left?
Better you address.
No, so one thing, Mr. Abhaya, and maybe I would request Harsha to add, is when it comes to retirement, first, ideally, you should start as early as possible. But since you said you have now only 5 years to sort of retire, makes sense to allocate in hybrid funds so you don't take significantly risk in your portfolio, because you only have about 5 years to retire. And that's where I would believe both balanced advantage and multi-asset products become very suitable, because they can change allocation between equity and fixed income based on how market conditions are. So these products can help you create a portfolio, and then you can systematically start withdrawing. One of the most underutilized, I would say, part about mutual fund industry is SWP. All of us know the benefit of SIPs, that SIPs give you disciplined investing, staggered way of investing into Indian markets. But what SWPs also help is for people who want to retire or want frequent cash flow. SWPs can create a good stream of effective tax efficient ways to prepare for your goals. And like you rightly pointed out, for retirements, SWPs can work wonderfully well, and we believe hybrid is a good segment that they can look at.
And just to add, when
Yeah.
one can also take help of an investment advisor, that is a much better way to do.
No, no, absolutely. So, of course, you should definitely consult your financial advisor who can give you far more detailed information after understanding all your facts. What we have only just highlighted are basic, simple things that you could look at investing. And maybe last question, Harshad, is when it comes to hybrid funds, should investors look at investing in lump sum, or you believe SIP is a good way to invest through hybrid funds as well?
No, I think for a dynamically managed hybrid funds, lump sum is the best way to go, because asset allocation will be done by us, or by the fund. One need not really, it doesn't really matter where the market valuations are. So to that extent, I think simple answer is lump sum is
Lump sum is
fine.
good.
If it's a pure equity, then one can want to stagger, take advantage of market movements.
Correct.
But here I think market movement advantage are taken by the fund itself when they
Yeah.
reallocate
So
across.
maybe like Harshad said, as the equity levels sort of go up, the equity levels within the fund can be reduced and vice versa. And hence the fund can do this dynamically on your behalf. So thanks, Harshad, for your time and for deciphering questions and taking as many questions as possible from investors. And thank you, investors and partners, for joining in today and hearing our perspective on why hybrid funds are an important part of your portfolio. Hope you found this webinar useful. Please do share your feedback with us, and we'll be happy to incorporate your feedback and your views in our subsequent webinars.